I've been doing some research lately on dividend growth stocks. 3 stocks have topped the list and should be considered by everybody who is a dividend growth investor. If you want to see what those are, stay tuned. Hey guys, Kevin Burgess back again with yet another video. Today I want to talk about dividend growth stocks. These stocks that we're going to talk about today have some significant growth in the past, and we hope that that continues for the future, but I wanted to share with you those 3 stocks. We'll go into a little bit of detail around them. And as you guys know, I am not here to tell you what stocks you should be investing in. My goal is to share with you what I come across, the details around that, and you get to make the decisions as to whether it's in your portfolio or not. If you're new to the channel, what we're about is dividend growth investing. And today we're going to focus on stocks that have grown their dividends significantly over the last 5, 10, and even 20 years. So without further ado, let's get started. So the first stock I want to share with you today is Landstar System Inc. You can see that they closed the day at 165.43. Over the last 5 days, they're down about 2.4%. However, over the last year, they are down only 0.89%. Now let's move on and see what is so attractive to me about Landstar Systems. First of all, you'll notice here in Simply Safe Dividends that their dividend safety score is 87 out of 99. That's considered very safe by Simply Safe Dividends. However, the challenge here is that their dividend yield is only 0.73%. We'll talk about that in just a minute because that's a little bit misleading. So who are they? Landstar System provides integrated transportation management solutions in the US, Canada, Mexico, and internationally, or they have the capability to provide integrated transportation management, and they do so without investing a lot of heavy capital into their process. Let's look at their dividend growth. You can see that over the last year, they grew their dividend by 20%. Over the last 5 years, they've averaged a growth of 22%, and over the last 10 years, they've averaged 16%. And moving on, you see here on the screen before you special payouts. So if they have a 30-cent per quarter dividend, that's $1.20. Each year for the last 2 years, they've paid a special dividend of $2 on top of the $1.20. And if you add that together, that's roughly a 2% yield. Now, obviously, we can't depend on the special payouts to be paid every year, but it is intriguing that they do offer these special payouts when times are good. So let's look at some of the financial metrics. Their payout ratio is in the 9%, 13% range. It is very, very low. That speaks well for their ability to continue their dividend and even increase that over time. Their free cash flow payout ratio is just as good. Anywhere from 8% to the 17% range. So really incredible free cash flow payout ratio. Their earnings per share, you can see the up until their forecast for the next year, it's been up and to the right. Obviously, as the economy slows, transportation is expected to slow. So they are projecting that the next year is not going to be as good as it has been in the last 2 years. But certainly much better than it was in 2020, 2019, 2018. Moving on then to shares outstanding, you can see in the last 10 years, they've bought back about 10 million shares of their company, which is pretty significant. That's over 20% of their shares have been repurchased over the last 10 years. You can see that their sales are up and to the right. Their return on invested capital is a whopping 53%. That is an incredible return on invested capital. I love to see that. In terms of debt, they have 0 net debt to capital. That means they have more cash on hand than they have debt. And you can see an incredible interest coverage ratio here. For the debt that they do have, they're able to cover it with at 138.8 times by their operating income. Let's take a look at fast graphs for them. You can see that this black line indicates the share price. The orange line indicates a 15 times earnings number. And then the blue line indicates what investors typically cause their stock to trade for, at least over the last 9 years. So instead of 15 times earnings, this is usually trading at about a 20.4 times earnings, which is their normal PE ratio. So how have they performed compared to the S&P 500 over the last 9 years? You can see here that LSTR, which is Landstar, has had compounded annual growth of 17.19% every year over the last 7 years here. So 17.19% return over the last 7 years compared to 11.08 with the S&P 500. So Landstar has performed very well. What's their valuation? Let's take a look at what Morningstar says. They say that they're valued at about $158. Alpha spread is something pretty similar to that. So as we discussed early on, the price for Landstar is about $165 with a fair value of around $158. They're getting close to a fair value range. So I think this is something that I'm going to keep on my watch list. I would suggest that you keep it on your watch list as well. I think there's a lot of potential here for this company. So let's move on to the second stock I want to talk with you about today, and that is Carlisle Companies Incorporated. CSL is the ticker symbol. And for some reason, their chart is not available in Seeking Alpha. So we'll sneak over here to Yahoo Finance, and we can see that they closed today at 233.92. If we look a year ago, we can see that they were trading at about 227. So they are just a little bit up from where they were last year. You can see, however, there was a period of time, though, around the July, August, September timeframe where they had some significant gains. They have come back down. We'll talk a little bit about that here as we move forward. Let's go to Simply Safe Dividends. We can see that Carlisle is a 99, very safe dividend as rated by Simply Safe Dividends. Their dividend yield, again, is pretty low at 1.28%. Who are they? They are a manufacturer of engineered products. They basically are in the building business. They provide building supplies, so roofing, heating, ventilation, air conditioning, hardware, sealants, waterproofing products. Let's look at their dividend growth. The latest dividend increase was in August of 22 at 39%. That's pretty incredible. The last 5 years, they've averaged 10% per year. And the last 20 years, they've averaged 9% per year. So pretty consistent growth from a dividend perspective. They've paid an uninterrupted dividend for 45 years, and they have a growth streak of 45 years. That is incredible. Let's look at their earnings payout ratio. It's down around the 12 to 15% range, so that is phenomenal. And their free cash flow payout ratio looks good as well. Look at their earnings per share jumping way up in the last 12 months and projected to be even higher in the next year. There's a caveat here, though. They're in the building material business. So if the economy slows down around the world, it could have an impact on their ability to produce sales and to get earnings from those sales. Looking at their shares outstanding, they have come from 63.6 million down to 52.8 million in the last 10 years. So that's a pretty nice reduction of shares out there. Total sales are up and to the right, which is what we like to see. Look at their return on invested capital. It used to be in the 10, 11, 12 range. Now it's 21%. So they have done a really nice job of improving their efficiency. When I look at their net debt to capital, it's 0.43. Looking then at their interest coverage, it is 13.77. So their debt is not significant to them. They are very capable of covering that debt as they move forward. Let's look at valuation. We're going to go to Morningstar. You'll see that Morningstar has a Q rating beside this fair value. That means that an algorithm calculated that, not an individual or not an analyst. So the algorithm for Morningstar calculates $248.50. Their last close, it says 237.01 here, but we know that as of today, it closed at 233.92. which seems to be in a good fair value range for according to Morningstar. But when I go to Alpha Spread says the intrinsic value is $341. And that's pretty consistent between the DCF value at 344 and a relative value of 338. So that means that on a base case, they're undervalued by 31%. So Carlisle Companies is going to be included on my watch list moving forward. And it may be one that I pull the trigger on here, relatively soon. So the third and last stock I'll bring to your attention today is Texas Instruments. Now, in full disclosure, I own some shares of Texas Instruments already, but I think it's worthwhile discussing them. You can see that over the last year, they're down about 4% overall. Texas Instruments has a dividend safety score of 90 per Simply Safe Dividends. They have a dividend yield of around 2.9%. Let's look at some of their growth stats here. Their latest was a 7.8% increase in their dividend. Look at the last 5 years, 21% on average per year, very fast. And then over the last 20 years, 22%, which is also very fast. Texas Instruments has paid a dividend over the last 60 years, and they've got a dividend growth streak of 18 years. Let's look at some of their financials. With the economy slowing down, their earnings payout ratio is going to jump up a bit. I'm not concerned about that for them. Their free cash flow ratio as well will jump up a little bit. Still manageable. Their shares outstanding have come down from 1.15 billion shares down to 931 million. Their sales numbers are pretty much up and to the right, which is what we like. Their return on invested capital is in the 47% range. That is phenomenal. Their net debt to capital is 0. They must have more cash than they have debt. And their ability to cover their interest costs is 52 compared to the 8 that is preferred for semiconductor firms. Let's take a look at Texas Instruments on fast graphs here. You can see that Texas Instruments is rarely ever close to the orange line, which is the 15 times earnings. It typically is around 21 and a half times earnings. So it's currently sitting at around just under 19 times earnings. So it's certainly within a fair value range according to fast graphs. And when I look at Morningstar gives them a fair value of 158, and they're currently trading around 170. So we're getting in a range that could be worthwhile for Texas Instruments. Let's check out Alpha Spread's intrinsic value. They value them at 134. I'm not sure that makes a lot of sense. They say the DCF value is 100. I don't really buy that. But anyway, according to Alpha Spread, they're overvalued by 22%. I think the 158 value is probably more in line with what we should expect. And then one last thing, some news on Texas Instruments today, hot off the press. Javier Villan to become next president and CEO of Texas Instruments on April the 1st. Their current CEO and president, who is Richard Templeton, will be transitioning out of the role of president and CEO and into the role of a board chairman. This is evidently a standard succession planning process for Texas Instruments. This gentleman, Javier Villan, has been with Texas Instruments for 24 years. He has served in various roles throughout the company and is also has already been elected to the board in 2021. So, this is very well planned, and seems like Javier Villan is going to be able to basically just take the reins and continue to drive Texas Instruments in a favorable way. So I'm looking forward to that. This is not alarming. This is not an issue. It is actually a very standard succession planning for Texas Instruments. Texas Instruments is a company that is not only on my watch list, but is also in my portfolio. I do plan to keep an eye on it to add some shares here soon if they pull back. Well, that wraps it up. Those are the 3 stocks I wanted to share with you today. Hopefully, you're going to look at those a little bit further to see if they're at least on your watch list moving forward. So if you like this kind of video, if you wouldn't mind, click that thumbs up button, that would be awesome. I really, really appreciate that. It means the world to me. And then secondly, if you do like this kind of material, consider subscribing to the channel. I'd love to have you along for the journey. And with that, I will see you on the next video.